Hey everyone, imagine this. On February 10th, 2026, just days ago, the Trump administration locked the biggest names in banking and crypto in a room at the Eisenhower Executive Office Building. JPMorgan, Goldman Sachs, Coinbase, Ripple, Circle, all fighting over one thing: whether you should earn yield on your stablecoins. The meeting? Called productive. The result? Total deadlock. And if they don't fix this by the end of February, the most important crypto law in U.S. history could die. If you're holding USDC, USDT, or any stablecoin, or even thinking about jumping into DeFi, this directly affects your wallet. Stick around, because I'm breaking down exactly what's at stake, who's winning, and what happens next. If you want more real-time crypto policy breakdowns like this, smash that subscribe button and turn on notifications right now. We're literally in the middle of history here. Why does this even matter? Stablecoins are the backbone of crypto, over $200 billion in circulation, used for trading, payments, DeFi, everything. But right now, the whole fight is about one word: yield. Those rewards, that interest you can earn just by holding them. Banks are terrified. They're saying if stablecoins start paying 3 to 4% yield backed by safe treasuries, why would anyone keep money in a low-interest bank account? They call it deposit flight. Trillions could vanish from traditional banks, killing loans for homes, cars, small businesses. Crypto side? Yield is oxygen for DeFi. Without it, the U.S. risks losing its edge to places like Singapore or the EU. And this deadlock is holding up the Clarity Act, the bill that finally draws clear lines between SEC and CFTC oversight, giving crypto real regulatory certainty. No deal? The bill stalls. Midterms hit, and we're stuck in legal gray zone for years. All right. Let's break it into the 4 big pieces everyone needs to understand. The core conflict: innovation versus deposit safety. Banks say yield-bearing stablecoins equal unregulated bank accounts. Their fear: $1.5 trillion in retail deposits could flee. Money goes to treasuries instead of local loans, bad for Main Street. Crypto's counters: yield fuels liquidity pools, trading, governance. Ban them, you kill DeFi and push innovation offshore. Example: think of a stablecoin like a digital dollar in your wallet. Banks want it sterile, no rewards for just holding. Crypto wants active use rewarded, like earning on liquidity you provide. The deadline squeeze. White House said compromise language by end of February 2026, or the bill risks midterms chaos. March 1st, Senate Banking Committee could stall it forever. Why the rush? Election years kill complex bills. Fail now, restart in 2027. Crypto stays in limbo. Banks' one-page stance: total ban. Banking groups dropped a short doc called Yield and Interest Prohibition Principles. No rewards, period. Not even from exchanges or platforms. They want stablecoins as pure payment tools, nothing more. Crypto's counteroffer: the savings account concession. On February 13th, Digital Chamber, led by CEO Cody Carbone, fired back with principles. Big move. They're willing to scrap rewards on static holdings, idle stablecoins just sitting there. This hits banks' main fear head on. But they're drawing a line: protect rewards for active stuff, like providing liquidity to pools or participating in governance or DApps. Carbone's quote sums it up: if banks keep demanding blanket prohibition, this legislation goes nowhere. Status quo means unregulated rewards continue via exchanges. Quick myth busting: 3 big ones floating around. Myth 1: banks just hate competition. Wrong. It's existential. Banks lend out deposits. Stablecoins park in treasuries. A shift could shrink credit creation big time. Myth 2: crypto won't budge. Actually, they're conceding on passive yield. That's huge. It's like saying, fine, no savings account killer, but don't kill DeFi. Myth 3: this is just crypto whining. Nope. White House advisor Patrick Witt called for a scalpel fix, ban idle yield, keep active rewards. Even the admin sees a middle path. What can you do right now? Here are 4 actionable moves. Stay informed on key players. Follow Digital Chamber, Cody Carbone on X, and Senate Banking Committee updates. Knowledge is power when laws change. Imagine being ahead of the next pump or dump from policy news. Diversify your stablecoin strategy. Use platforms offering active rewards while this plays out. Don't go all in on passive yield that might get banned. Engage. Comment on bills. Support pro-crypto PACs. Your voice and donations helped get Genius Act passed in 2025. Hedge globally. Consider exposure to non-U.S. stablecoins or jurisdictions with clearer rules. The U.S. wants to be crypto capital, but don't bet everything on D.C. Quick real-world parallel. Look at the Genius Act from July 2025. It banned issuers from paying direct interest, but left the loophole for exchanges to offer rewards. That's exactly what banks are trying to close now with Clarity edits. Crypto gave ground there already. Now they're saying, we compromised once, meet us halfway. If banks push too hard, they risk killing the bill and keeping the loophole alive. Ironic, right? 3 lesser-known nuggets. The 2-year study banks want, crypto's okay with it as long as no auto rules come from it. Smart condition. Bipartisan math needs 60 Senate votes to beat filibuster. Republicans have 53. Gotta flip 7+ Dems. That's why compromise is non-negotiable. Global risk? Limbo pushes talent and capital to EU or Singapore. U.S. dollar dominance in digital? At stake. So, recap. Banks fear deposit flight and want total yield ban. Crypto concedes on passive holdings but fights for active rewards. White House pushing hard. Next few weeks decide if Clarity passes or dies. This isn't just policy wonk stuff. It's about whether America leads crypto or watches from the sidelines. If this breakdown helped you understand the stakes, drop a like, comment your take. Banks win or crypto wins? And share with anyone in crypto. Subscribe for more updates. We'll track the March markup and any breakthroughs. What do you think happens by end of February? Let me know below. Thanks for watching. Stay sharp out there. See you in the next one.